Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates. 10-year note yields back below 3%. Call last week. We got there. We got to as high as we've been in 4 years, and we stayed up at above 3%. It was a brief stay. Call it a long weekend, if you will, and now we're back below. A lot of caution being thrown into the wind here from a technical perspective. We did touch those old highs. We bounced off them. There will remain resistance from the yield perspective, support for price, and that's going to kind of stay in play here. That 3% to 305 area, we need to push through that and sustain above those levels. We need some help, whether it be earnings, whether it be employment, whether it be FOMC, whether it be something else. Those are the things that could get us above 3% again. However, there are the geopolitical risks. There's the Iran nuke risks. There's a lot of uncertainty in the market, and those are the things that are going to push us back towards 275. And a little bit of the tug of war today, the latter one and the two, we traded back below 3%. So not a huge deal today, but just the fact that we aren't above 3% anymore, I think sends a little bit of a message to the market. Market volatility, while we're looking at just all those things I mentioned, all that data, all the information, all those announcements, all the uncertainty, Treasury volatility was down again today. It's been down for about 3 or 4 sessions in a row, which suggests to me that the market has reached its pinnacle, at least for now, and is going to kind of waft back into that old range that we had for so long. Recall, not too long ago, we were looking at 275 to 285. We bumped it up to 275 to 290, and then it was kind of 280 to 295, and that's kind of the range we touched today. We didn't get back in that range, but we were headed back towards it. We touched it. I think the market right now feels very comfortable being near 3%, but just below it, and that's probably what we'll see. As long as all geopolitical risks remain the same, we have data from the Fed and data from employment. Those are going to be the 2 key data points, along with several others, and earnings, which we'll watch. But I think that right now, those are the 2 keys that could knee-jerk us either back above 3% or back into that old range, something that we probably won't feel until the end of the week. And if you look at what's happening in 2s10s, don't recall, got to its lowest in over a decade at around 41 and change. We steepened that, up to 46, 47. It looked like things were going to reverse. Maybe 10-year yields were going to get to 3% and take off, and that didn't happen. And what happened was 10-year note yields came back down. However, 2-year note yields remain stubbornly elevated. So that what we thought was a steepening has now reversed itself. We're actually very close to those decade lows in the 2s10s curve. And it doesn't mean much. We're not going to raise rates this week. We are priced to raise rates in about a month. And that in itself, if we raise rates, is going to push the 2-year note yield higher or keep it higher, whereas the 10-year note's really trading on a lot of different variables. So right now, the curve could be sending mixed messages. It's a lot of uncertainty out there. There's a lot of fear and possibly a lot of risk that isn't being reflected in volatility, but it's out there and being reflected in the curve. And right now, the higher the Fed pushes rates and the steadier that 10-year notes remain, that 2s10s is going to continue to get flatter. And I think right now at 40 to 45 basis points is as flat as it's going to get, unless we need a catalyst push, like we need to get 10 years back above 3%, whether it's a strong employment or a hawkish Fed. We need something to get the curve, to jumpstart the curve again, because obviously 1 or 2 days of seeing a steepening move isn't enough, because we just took it all back in 1 or 2 days. So right now, the Treasury curve telling you uncertainty still remains, despite the fact that the Fed is looking to raise rates in the short term. This is Todd Colvin coming to you from the floor of the CME Group.